I'm going to expand this a little further with what's going on in our markets. Okay. There are things called high dividend stocks, right? What are those? A lot of the consumer cyclicals are high dividend stocks. Okay. So you have to also understand where our interest rate picture is. We had ZIRP policy for what, 15 years, since 2008? Well, all the way 2008 to 2022, after the great financial crisis, the Federal Reserve decided to keep the rates at zero, literally zero. Okay. And then what did that do? 15 years of easy money, free money, pumping, the printing machines, what happened? We created man-made inflation, right? And what's the definition of inflation? Definition of inflation is too many dollars chasing too few goods. And look what happened, right? We've been experiencing inflation since 2019. Everything we touch has gone up double, or if not more. So then what's the antidote for inflation? That it was man-made, right? Now, am I blaming the Fed? To a point, yes. I think 15 years of zero interest rate policy is too long. However, there are black swan events like happened the pandemic. Nobody anticipated that, right? In fact, the Fed was talking about, lowering the balance sheet after the 2008 financial crisis. But it seems like every 10, 15 years, there is one of these black swan events. And the Fed steps in, prints the money, adds to the money supply, supports the economy. The reason is we don't manufacture anything. We are a service-based economy. We used to be a manufacturing economy, but now we're service-based. 80% of our economy's GDP is made up by consumer spending, meaning we have to borrow and we have to buy stuff. Most of the time, the stuff we don't need. However, my point in all of this is when markets start drawing down on the first topic, like I talk about DCA, dollar cost averaging, doing certain, rainy day funds or investment accounts. Now, I'm taking this a step further, right? So why not? I mean, yes, the high dividend or high dividend paying or yielding stocks or ETFs are not going to give you the return probably of the S&P 500 on a nominal basis, meaning the appreciation may not be there. The appreciation may only be there 3, 4, 5%, because they're companies like, let's say, Coca-Cola's and consumer cyclicals or pharmaceutical stocks. Like most of the time, those have, or some bank stocks or some oil stocks. So, but then there are ETFs that are created to have a bucket of these stocks in there, and they get an average yield return. Some of them are as high as 7, 8%, right? Now, here's the deal with this. If you're going to dollar cost average, you should also look into high yielding stock ETFs. The reason for that is, I'm going to connect it to the Fed's policy of zero interest rates. During zero interest rate policy, these high dividend paying ETFs did extremely well because they're paying you 6, 7%, right, in dividends, and the bank interest rates are zero, right? If you go put in a CD, you were getting nothing, or a money market fund. What were you, 0.1%, right? Or savings account. So what happens? Those stocks do very well in a low interest rate environment, or those high yielding dividend ETFs. Well, when the rates were pushed up to kill inflation, right? The man-made inflation that we created, what happened to those stocks? They all tanked, because now you have a competitor in the US government issuing you, or CDs or money market funds, giving you 4 or 5% risk-free, because stocks, believe it or not, even with a high dividend, they're a business. If the business goes south, stock is going to go down, obviously. But so now there's a competitor. Now these high paying, high dividend yielding stocks, ETFs, did not do well, while what was doing well? The Mega 7 was doing well. The S&P 500 was doing well, right? By the way, the S&P 500 has about 2.5% dividend yield, maybe a touch under that. So, but going back to this, the high yielding ETFs, you can also look into these now. The reason for that, the reason I'm saying that is because I think we're going to go into an interest rate lowering policy coming up, most likely starting in September. So during zero interest rate policy, these ETFs did extremely well, right? Now that the Fed is thinking, okay, we need to soft land this economy, we need to start lowering rates, because all the indicators I'm watching are yelling, screaming recession, right? From housing, from credit card defaults, from car loan defaults, from mortgage defaults. They're all going through the roof at the moment. And for that information, by the way, we talked about that in the past shows. You can go to FRED, FRED, Federal Reserve, Federal Reserve, I forgot what it was, but data. Anyway, FRED is FRED or federalreserve.com, and then you guys will find it if you want to follow some indicators on the macroeconomic situation. So now that they're going to lower interest rates, these ETFs are going to do really, really well, right? And remember the rule of 72, right? If you're going to get 6, 7, 8% dividend yield on these stocks and a little bit of appreciation, okay, you may get over 10%. So, your choice of DCA is double fold now. You can do indexes, and then you can do also these high yielding ETFs. So what to look for to invest in dividend ETFs, high yielding. A dividend ETF typically includes dozens, if not hundreds, of dividend stocks. Absolutely. It's like a bucket, right? That instantly provides you with diversification, which means greater safety for your payout. Even if a few of the fund stocks cut their dividends, the effect will be minimal and the fund's overall dividend will stay the same. So how do we look for these things, right? Obviously, Google is your friend. You can Google it. I'm not going to give you guys specific names because that would go into financial advice. So we'll pass on that one. So find broadly diversified dividend ETF. You can typically find dividend ETFs by searching for them on your broker's website. Sure. Broker meaning, Schwab or Robinhood or Ameritrade or whatever, right? And once you find your ETF, right, analyze the ETF. Make sure the ETF is invested in stocks, also called equities, right? Not bonds. Now, there is high yielding bonds as well, but then in an economic slowdown, you really want to be careful with high yielding bond ETFs, because if what happened to bond ETFs is they got killed, right? When the Fed raised the rates from 0 to 5, bonds. So bonds and bond values and interest rates are also an inverse relationship. So if the rates go up, the bond's value will go down. Like every bond is $1,000. Okay, so if an interest rate goes from 0 to 5, the bond's nominal value will go from, on a, let's say, 20-year bond. It will still mature at 1,000, but it will go from 1,000 to maybe 800. So you're eating on that part. So we're not talking here high yielding bond ETFs. We're talking high yielding stock ETFs, right? Check out the dividend yield. I've seen as high as 8, and I've seen, the average is about 5.5, 6 these days, which is above the 20-year bond, right? And with a little bit of potential growth you have in there, I think they're pretty decent returns. Look at the past, obviously, performance, but does not guarantee. But then you have the dividend safety in there, right? 5-year returns, 10-year returns. The expense ratio has to be really, really low, so you have to pay attention to that. Like on the spiders, the expense ratios are really, really low these days. I mean, they are definitely less. It should be definitely less than 0.5, preferably like 0.2 or lower. And then obviously AUM is important. It's called assets under management. I mean, how big is the fund, right? And the bigger it is, the better it is, the more diversified it is. And then you just simply go buy the ETF, and you can DCA into this as well. So now that the market's on a drawdown, okay, market's down. I mean, on triple Qs is down about 10% last time I checked it, or 9%. On the S&P 500, about 5%, right? Do you play defense? Do you start doing this? Well, what I'm doing with my own money, with some of it, is now that I see interest rates going back down again, right? These stocks will do better in these funds, and then the value of the dividends that these ETFs are offering you are going to be also more valuable, because the competing interest rates environment is more positive for them. So interest rates are going. If the interest rates are going to get cut, and the guessing game has begun, everybody's saying, oh, November, but I think it's going to be earlier than that, because I think the economic data that's coming out is horrible. So they're going to be forced to start lowering interest rates. They were supposed to cut interest rates 3 times this year. Now they're down to 1, but I think it's going to be 2, and the forecast for next year is 4 interest rate cuts. Now, you guys also have to understand, Fed does not cut the interest rates unless the economy is slowing down, okay? The reason they're doing that is because they're trying to do soft landing. This thing, it's like 747 soft landing. I don't know, on a little strip is not going to work out. We don't have that much luck, but they will definitely start cutting rates. So these high-paying dividend ETFs are going to be looked at more favorably. Again, don't forget the rule of 72. Okay, slow and steady is the way the game should be played.